The big, beautiful bill just changed one of the most controversial parts of the tax code, and that is the SALT deduction. And it's a big shift. Starting in 2025, the cap jumps from $10,000 to $40,000. For a lot of people, that's going to completely change the math on whether you take the standard deduction or just itemizing them. And if you remember, the SALT deduction from the Tax Cuts and Jobs Act was a huge sticking point back in 2017 when they first capped it at $10,000. It was a straight up blue state versus red state issue. You have representatives from places like California, New York, and New Jersey, states with high income and property taxes, who were absolutely furious. They saw it as an attack on their constituents. Then you had the red states, places like Florida and Texas, arguing that people should not be forced to subsidize taxpayers in high tax states. It was a messy fight. The most significant negotiation during the One Big Beautiful Bill was the SALT deduction because the House Republicans from those high income tax states would not vote in favor of the bill if the SALT cap did not increase in the new bill. And the Republicans needed almost every single vote to make the bill pass. And now they finally got a win with $40,000, but only on a temporary and provisional basis. So let's start with the basics of what's actually changed. The One Big Beautiful Bill has capped the SALT deduction at $40,000 for the 2025 calendar year, and it's a temporary change, and that's a key point. In 2026, the amount is going to go up slightly to $40,400, and that's because the bill includes a 1% annual inflation adjustment, and it's just a way of Congress making sure the deduction keeps up, well, the rising cost of everything. The adjustment will stay in effect through 2029, but starting in 2030, the deduction is set to revert all the way back to the old $10,000 cap. So think of this as a 5-year window to take advantage of some pretty significant tax savings. And it's not a permanent change, which is a little frustrating to those people in the high income tax states, but it is a huge step in the right direction for a lot of people. Now, here's where it gets a little more technical, but I promise it's not going to be that complicated. And let's talk about how the new SALT deduction works with something called an income phase out. This part is important because it tells you if you're actually going to get the full $40,000 deduction. And the income phase out range starts at a modified adjusted gross income of $500,000. If you're single, that's your starting point. And if you're married and filing jointly, that's also the number. And in 2026, that threshold will also adjust for inflation, going from $500,000 to $505,000. The way the bill is written, your SALT deduction can be reduced by 30% of the income you earn above that $500,000 threshold. And let's walk through an example real quick. Let's say your income is $550,000. That means you are $50,000 over the phase out threshold. And so you take that $50,000 and multiply it by 30%, and that gives you $15,000. That's the amount your deduction is going to be reduced by. So instead of being able to deduct the full $40,000, you'll only be able to claim a maximum of $25,000. Now, I'm pretty sure somebody named Bob in the comment section is going to say something like, nobody makes $500,000 a year, sigh. But listen, Bob, this is a financial independence channel, and high income earners watch my videos too, and I'm not going to leave them out. Anyway, let's do another one just to make sure we're on the same page. Say your income is $600,000. You're $100,000 over that threshold. You multiply $100,000 by 30%, which is $30,000. You subtract that from the $40,000 cap, and your maximum deduction drops all the way down to just $10,000, which, if you look at the math, is the same limit we had before the bill. So for the highest earners, this new cap really does not change anything. And if you're looking at this and thinking, wait a minute, doesn't this whole thing mainly help wealthier people? Then you're not wrong. And I'm not here to stir up a political argument. I'm just walking you through the numbers with the new $40,000 SALT cap, and itemizing your deductions starts to make a lot more sense. But here's the reality. The people who have the most deductions to itemize are usually the ones with bigger mortgages and higher property tax bills. And let's be honest, who typically qualifies for those larger mortgages? It's generally higher income earners. So here's how it works. If you're a homeowner who itemizes, you can take advantage of the mortgage interest deduction. And that's the rule that lets you deduct interest on the first $750,000 of your mortgage. That limit has not changed from the old law. It's still the same. But the big, beautiful bill threw in something new, and that's the mortgage insurance premium deduction. And basically, if you're paying mortgage insurance because you put down less than 20% when you bought your home, you can now treat those insurance payments as if they were mortgage interest for tax purposes. That's a pretty big deal for buyers who could not swing a full 20% down payment and are stuck paying that extra insurance every month until they build up 20% equity in their home. Those premiums used to just feel like a sunk cost. Now, at least for tax purposes, they are deductible, which can make a noticeable difference when you are running the numbers on whether to itemize. And let's not forget, mortgage interest rates right now are still much higher than they were just a few years back at the time I'm recording this video. And that matters because higher rates means you are paying more interest, and more interest means you have a better shot at getting past the standard deduction threshold. And let me walk you through a couple of examples so you can see exactly what I mean. Say you take out a $500,000 mortgage at a 6.5% interest rate for 30 years. In your first year, you're looking at about $29,500 in mortgage interest alone. Now, if you're married and filing jointly in 2025, the standard deduction is $31,500. So right out of the gate, your mortgage interest alone gets you pretty close to that number. But if you're single, the standard deduction is only $15,750, which means a $500,000 mortgage at that rate already puts you way over the standard deduction. In that case, itemizing makes a whole lot of sense. Now, let's just scale it down a little bit and say you've got a smaller mortgage, say $300,000 at the same 6.5% rate. Your first year interest would come out to about $14,000, and that is not quite enough to beat the standard deduction for a single filer, but here's where it changes. What if you also have $10,000 in state income tax, or you're paying property taxes or making charitable donations? Start stacking those together, and suddenly you're well over the standard deduction. And once you cross that line, you can start itemizing everything, which means you can take advantage of the new higher SALT cap and potentially save yourself a lot more in taxes. And it's a big shift in how the math works, right? And for some people, it's going to open the door to tax savings they could not tap into before. Now, a lot of people think you have to be in a state with a state income tax to use the SALT deduction, and that's just not true. You don't have to have a state income tax to take the SALT deduction. The rule says you can deduct either your state and local income taxes or your state and local sales taxes. But here's the most important thing to remember though. You cannot take the standard deduction and the SALT deduction at the same time. You have to choose. You have to itemize all of your deductions to take advantage of the new $40,000 SALT cap. Now, if you're like most people, you probably just take the standard deduction every year because it's simpler. You don't have to save a bunch of receipts or worry about keeping track of every little thing. But with this new law, it might be worth the extra effort. Now, if you live somewhere like me and in Nevada, there's no state income tax to deduct. So in this case, I would be looking at using the SALT deduction for either state and local sales taxes or property taxes. And that's the choice you get: income taxes or sales taxes, but not both. Now, if I lived in New York City, it would be a completely different story. I would almost certainly be focusing on deducting state and local income taxes because they are much higher there. And that is where the biggest deduction potential would be. And I'm going to say this again because people misunderstand the SALT deductions. You cannot take the standard deduction and the SALT deduction at the same time. If you want to claim the SALT deduction, you have to itemize. And when you itemize, you're adding up all of your eligible deductions and seeing if they beat the standard deduction amount for your filing status. Now, when you itemize your deductions, you are basically handpicking all the tax breaks you qualify for instead of just taking the standard deduction. And there are a few big ones most people look at first. And there's the medical expense deduction, which lets you write off certain out-of-pocket medical and dental costs, but only the portion that's more than 7.5% of your income. Then there's the property tax deduction, which falls under the SALT deduction rules, meaning you can deduct property taxes plus either your state and local income taxes or your sales taxes. And the mortgage interest deduction is another heavy hitter. You can deduct interest on up to $750,000 of mortgage debt, half of that if you're married filing separately, which can really add up in the early years of your loan. And if you're charitable, the charitable contribution deduction lets you write off donations to qualifying charities, which is usually between 20 and 60% of your income, depending on the type of gift. And these are the big four that many homeowners and high earners rely on. And for some, they can easily push their total deductions above the standard deduction. Now, let's use a simple example. Say in 2025, I paid $30,000 in mortgage interest. That's already getting me close to the $31,500 standard deduction for married couples filing jointly. If I am tracking every sales tax purchase and I make through the year, and I also have property taxes, I could easily cross that threshold. And in that case, itemizing and taking advantage of the higher SALT cap makes perfect sense. And of course, everyone's situation is different, and the right move for you is going to depend on your income, where you live, and what kind of deductions you have. And this is why I always recommend talking to a tax professional in your local area before making a decision. So at the end of the day, it really comes down to running the numbers for your own situation. If your mortgage interest, property taxes, charitable contributions, medical expenses, and other deductible costs add up to more than the standard deduction, itemizing could save you real money, especially with the SALT cap temporarily boosted to $40,000. But if you don't have enough deductions to beat the standard deduction, sticking with the simpler option might be the smarter move. And the good news is you don't have to guess. A good tax pro or even tax software can run the math both ways. So what do you think? Will you be taking a standard deduction this year, or is this the year you itemize? And this has been another beast of a video, and I hope you got a lot out of it.